Well, all right, so we're going to go ahead and get started. Again, good morning, everyone. Happy New Year. My name is Bernard Jeter, and I'm the Life and Annuity Specialist with Insurance Advisors Direct. Today is day 2 of our Life and Annuity Academy. A lot of information, a lot of great information is going to be given by some industry experts. You see one of them with us right now, Chris DeMARS. He's on the annuity side, one of our partners. Folks, this is going to be recorded and uploaded on our YouTube page. Let me start off just a little information on Insurance Advisors Direct. We are a full service FMO, and we actually pride ourselves on our 7 pillars of success. And that is our product offerings, our marketing services, lead generation, technology, sales tools, training and education, and administrative services. One of my favorites of our 7 pillars of success is our training and education. Like you see here today, I like to train folks and get them to understand, different concepts of life insurance and annuities. And we do that through our partners such as Chris to make this, to simplify your success. So with that, our lineup for today is we'll have Brandon HEGG with Dynamic Directions. Actually, they changed their name. And he's going to talk about how to attract more clients through wow moments. Yesterday, he talked about how to get more referrals in a way that worked. Pardon the pun, but very dynamic young man, great presentation he gave. Then we'll have Chris DeMARS here. He's going to talk about annuities in today's economic environment, and then guaranteed income for life. Then we're going to talk about how to marry the two, life insurance and annuities, to give you and your clients a more holistic approach. And then we'll have Nicholas MANCUSO from RETIRABLE, which is a financial advisory firm. He's going to talk about an incentive program we have, and then also that holistic approach using life insurance, using annuities, and the equity side or brokerage accounts. So look, good information going on today. Plus, at the end, we're going to have a couple of giveaways. We're going to have 2 $50 gift card raffles. So those that are on here, put your name in a hat, draw 2 names, and guys will get a $50 gift card. Plus, we will also have folks on that's on here. They will receive a free website design consultation, as well as social media marketing consultation. So here, waiting up. Brandon joined right on time here. All right, good morning, Brandon.
Good morning, how are you today?
I am doing well. I see you remember Chris DeMARS over here.
Absolutely, a lot of friendly faces on these. This is awesome.
Yes, sir. So Brandon here, you just jump right on in, man. It's your turn here.
All right, let me get this. I'm going to share the screen and we will dive right in.
Okay, all right, kind of distorted a little bit.
Excellent. Well, again, thank you for the opportunity to speak to the group and share some best practices here. What we're going to be talking about today is really focused on the start of what we were talking about, if you were able to join us yesterday, which is how to create wow moments for clients. Now, if you think about the way that you want to grow and you think about what's going on in the industry, there are really going to be 2 ways that you can actively grow organically. And that's doing more with the clients you have and acquiring new clients. And the start of acquiring any new clients is you need to create an experience that is referable. So we're going to spend some time talking about a few steps that you need to take, if you haven't yet, that will help you create the right kind of experience that's going to attract your top tier clients and create an experience that your clients can refer. So to just give you a quick background, if you weren't able to join us yesterday, my name is Brandon HEGG, as I know Bernard mentioned. I work with a firm called Extraordinary Financial Advisors. We work with about 150 to 200 advisors and agents across the country. And our big key is helping you build a better practice and overall a better life through that. So our advisors, our agents on average, were about 30% year over year in revenue. That includes last year, even when the markets were down. My specialty is in organic growth. So that's doing more with the clients you had and getting more clients. So I'm going to give you a lot of information today. And I'm going to try to end a couple minutes early and give you my email address, because if you want any help implementing this, shoot me an email that just says, hey, let's connect. And I can help you work through and figure out how to put some of these best practices into your business. So what's the problem we're solving today? Number one is, if you're not growing right now, you're in a decline, right? Don't want to say, if your business isn't growing, it's dying. But if your business isn't growing, you've got to figure out a way to get it away from shrinking. As people get older, as more folks retire, we need to think about, how do we continue to bring more of the top people into the practice? The second thing is, a lot of advisors, a lot of agents, a lot of folks don't have clear defined values that differentiate them from others. I'm going to talk to you a little bit about how you can create that, share that, and emulate some of the companies that do it really, really well. The third problem we're going to figure out is, how do you stand out from the competition? I was talking to someone yesterday, and one of the things that I helped them walk through is, if you think about the number of financial professionals, the number of financial companies that you interact with on a daily basis, the competition is huge for your client's attention and for your client's referrals. If I pulled out my wallet and I just looked through it, I would know that I've got my home mortgage with one company, I have a credit union, I have a bank, I've got my financial advisor, I've got my insurance agent, I've got credit cards, Visa, MasterCard, Capital One. Right off the top of my head, that's 8 companies that I get contacted by regularly to set up a talk, to consolidate funds, to take a new loan, to update my policy, to get a new policy. The competition around for the attention of your clients is absolutely at an all-time high. So we need to figure out a way for you to stand out so that you can build a moat around your client that keeps all of those other competitors away. And the last one is, how do we make sure that clients know what makes you different and know it in a way that they could share? So again, what we're focused on today are doing more with who you have and attracting new clients. There's a third driver of growth, which is mergers and acquisitions. We're not going to touch that today. That's a whole different approach. So what we wanted to start with, as I mentioned, is, how do you define your values? So if you think about some of these companies that are out there that have really strong client loyalty, I'm talking about your Ritz-Carlton, which is an example here. Talking about companies like Delta, companies like Chick-fil-A even has a very high consumer loyalty rating. Now, all of these are out of Atlanta, so maybe something's going really great in Atlanta. But what these companies do is, they have defined values, their employees know their values, and they review them regularly. What I've got on the screen here is the 12 Ritz-Carlton values that they go through with their employees every day. They talk about the values. They have each one of them share how they made a difference with these values. And every single employee carries a business card with this credo on it. It is so ingrained in their culture and in the way that they interact with their employees that it creates a experience that people pay a premium for. Look, if you've ever seen the hotel areas in a town where you go into a specific part of town and there's 8 hotels nearby. You know, maybe if we're going with the Ritz, you've got a Ritz-Carlton, which is their top of the line. You've got a Marriott, and you've got a Fairfield Inn. They're all Ritz-Carlton, Marriott properties, and they all really do the same thing. They provide a bed, they provide a roof so that you can go and spend the night, get up in the morning safely and be on your way. So why do people pay more to go to the Ritz-Carlton? It's all about what happens once you walk through the door. On paper, they're the same. A bed, a room, and safety. But once you go through the door, it's what the Ritz-Carlton does that allows them to say, we're going to charge you double, and they succeed and they grow. So what you want to be thinking about as a very first step is, how do you create and define your values? This is not your elevator pitch. This has to be what you hold true and what you and your team value as important and what you believe in. There are online tools. If you want access to them, I have some copies that I can send your way, a very simple exercise that helps you walk through and helps your team define what are the 5 values we hold dear. Now, once you've found those values, you need to determine how you want to implement and live those values. I've seen a lot of ways to do it. One of the really cool ideas I've seen is I work with a team that once we defined their values, they actually had coasters printed that had their values on it. So every client, when they come into the office and they sit down at one of their advisors, agents' desks, they get a coaster and the 5 values are right there. Every time one of their employees use a coaster or water cup, the values are there. I've seen teams that post them in the lobby when you walk in. These are what we hold dear. And they review them and recognize each other when they share and show those values to a client and to their other team members. So once you define your 5 values, you need to figure out how can you put them into your practice and how can you live them. The next move is you need to start sharing them with your clients. People want to work with others that believe the same thing that they believe. And as you share what your values are with clients, you're going to start to connect with them in a different way than you have in the past. Clients that believe what you believe are going to be more loyal, they're going to refer more, and they're going to be more connected to you to help you start building that moat around your clients. It also gives them a way to share what you do with other people like them. This ultimately, when you've got your values, creates your why statement. If you've ever seen the TED Talk with Simon Sinek, you may have read the book, Start With Why. There is a different relationship that's formed when you can talk about why you do what you do and not just what you do. Start with creating your values, figure out how you and your team want to live them, share them, and create your why statement. This will start to differentiate you from anyone else that's out in the industry. You know, if I look at some of the life insurance opportunities I get, you know, I may know that, yep, this one is a little bit cheaper, but I believe in this company more. That'll help you start to create that premium experience and attract people to want to be with you, even if there's lower cost options out there. The next thing is you need to think about what is your client experience. It's not the same as client service. In this day and age, client service is just expected. I make a phone call, they pick up the phone and answer my questions. That's an expectation. Doesn't count as client experience. So what you need to think about is these 3 key elements of client service. Number 1 is client contact. The number 1 thing that clients say when they're surveyed about their advisors, their agents, the number 1 thing that they wish they got more of is more contact. I'm going to share with you a contact model that can help you alleviate that, but that is the number 1 thing that clients wish they got more of every time. When a client leaves an agent or an advisor, when they're surveyed on the way out, I didn't get contacted enough, is part of almost the number 1 reasons they leave. What we deal with is out of sight, out of mind. So if the client isn't hearing from you, it's hard for them to assume you're still working for them. You may be reviewing their accounts. You may be, upping their information. You may be checking their beneficiaries. But if they don't know that you're doing that, they assume that nothing's going on. You need to contact clients more than you think you should. Think about the value that's expected and how you can go above and beyond. If you're hitting the expectations, you cannot charge a premium and you don't build the client loyalty that you want to. And then the last one is figuring out how to make sure you can get issues resolved quickly and setting the right expectations. What you want to create is wow moments. You want to avoid oh moments. So what I mean by this is, let's say with our hotel example, if you walked into a hotel and you saw this, amazing breakfast, or you got some gift when you walked in, or you walked into the room and I've had advisors do where if they have a client going on vacation, they send a bottle of wine to the room. That's a wow moment. You walk and you say, wow. And it doesn't have to be big. I had my vehicle in the shop to get the bumper fixed probably 3 weeks ago. And when I went to pick it up, they had vacuumed and cleaned the whole car. To me, I was like, wow. I thought they were just going to fix the outside of it, but they went above. It probably took them 10, 15 minutes to vacuum it out, but that was a wow moment for me. Little things like that. If a client walks into your office and you know that they like Diet Coke, and instead of saying, hey, can I get you something to drink? You just say, hey, Chris, here's your Diet Coke. That's a wow moment. And it costs maybe 75 cents and 3 minutes. Little things like that. What you want to avoid is oh moments. So, for example, I'll stick with the hotel. My sister was in town last week, and her and her boyfriend were staying at a hotel here in town. And they stayed with us on Thursday. They checked into the hotel on Friday. And I said, hey, how are things? How's your hotel? They said, well, the hot tub's out of order. That's an oh moment, right? When you walk in with an expectation and it's not met, yeah, maybe doesn't cause you to leave, but it's not going to cause you to come back. That's an oh moment. You want to figure out how, if there is an oh moment where the client thinks, oh, okay, how do you turn that into a wow? So another example, hotels. I was at a hotel a couple weeks ago, and I was supposed to have a shuttle to the airport. And we showed up at the front desk, and I said, hey, I'm here for the shuttle. And turns out they didn't have us on the calendar. I had already talked to them about it. We had agreed on the time. And when they said, oh, we don't have a shuttle for you, that's an oh moment. But what the attendant, the front desk person did is they said, hang on a second. They called the backup. Someone came in, took the front desk over, and they drove us to the airport in their vehicle personally. That changed an oh moment into a wow moment. It's little things like trying to figure out, if you find an oh moment, how do you go the extra mile? The first thing that you need to tell your team and you need to start to embrace is having the antenna up and radar on. That's again, a Ritz-Carlton saying. You need to be aware, and you have to be looking for every single tiny opportunity where you can provide a wow moment. Again, another example, recently my wife got a new vehicle. So I called our insurance agent and said, hey, got to update our auto policy. We've got this new vehicle. She took care of it, had it happen really efficiently. I said, great, that's what I expect. I give you the info, you make the updates, we pay any differences that come through. What I didn't expect was in the mail about a week later, I got a little card that said, congratulations on your new vehicle. We hope it's great. Keep it clean on us. And there was a little coupon book with 5 car washes for the local gas station that has a car wash here. Didn't expect it, probably cost them a couple minutes to write the congratulations note, maybe $20 to get the coupon book. But something as simple as that creates the wow effect of wanting to go back and wanting to make sure you stay with stay with that agent as we move forward. Another example, we bought a house 3 years ago, and we had talked to someone about getting our mortgage done. Now, when it comes to mortgage, that can be who's going to give us the best rate. It's a very transactional type of relationship. But what this person does is every single September 26th on my birthday, I get a little birthday card from them and a lottery scratch-off ticket. It says, hey, Brandon, happy birthday. Hope it's your lucky day today. Costs him 2 minutes to write the note, $1 for the scratch-off ticket. But to me, that's wow. He's still in touch with us. That's not an automatic marketing tool that goes out. That's a handwritten note that comes out from them. That's the kind of thing that says when, we want to eventually move, or if we do, I'm calling Brian, because he does these things. It's very simple steps that create that. Having the ability, if a client has an anniversary, or if their pet is ill, or, as they tell you these little things, have your antenna up and radar on for little ways that you can acknowledge and give them a wow moment. The other thing to do is continue to think about who, not how. I'm going to touch on that in a little bit later, but this isn't something that you, as the business owner, or maybe as the CEO, or as the lead agent advisor, have to do alone. Your whole team can embrace this, and you need to give them the autonomy to say, hey, I heard this person's child was graduating this week. I'm going to send them a card and a little gift. Something as simple as that, where they don't have to necessarily come and get your approval, can help create the efficiency and share the responsibility across the practice, that everyone is responsible for these moments. The best client experience is unexpected. I didn't think it was going to happen, and wow, that was really cool. That's what you have to do, is you want to create these unexpected moments. That's going to take you above and beyond in your clients. You want to make people feel special, that they're one of your only and favorite clients that you work with, because you want them to think of you as their only resource to get the help that they need. You need to treat them as if they're your only client. It's a two-way street. Now, how do you do this? One of the biggest things we work on is capacity. You need to be thinking about capacity. So agents and advisors can personally service a limited number of clients. Now, depending upon who you listen to, if you follow Michael Kitces, if you listen to some of the larger broker dealers, if you've read a book called Supernova Advisor by Rob Knapp, the maximum amount of personally serviced client relationships falls between 75 and 150. That's about when you start to reach capacity to deliver a really great client service model. So how do you handle it? The key is segmentation. If you haven't gone through and segmented your book to create different experience tiers, that's got to be something you start working on. 20% of your clients are your top clients. 40% will be your middle tier, and then another 40% will be your bottom tier clients. What you want to start to do is differentiate and create an experience tailored to your top clients. If you have everyone getting the same experience, you market the same way to every client, you create the same kind of service model for every client, you're going to attract your middle tier clients all day long. That's what you'll get. It's like throwing a net when you're fishing, you'll get the middle tier. But if you create a differentiator for those top clients where they feel extraordinary, they feel special, they feel like they are at this level of concierge-like service, they are going to start telling other people about you. And one of the things that we know is people tend to hang out with folks that are like them. So if you want to attract and target the top tier to replicate your top tier clients, they probably know and hang out with people just like them. That's how people tend to congregate and how to associate with one another. So if you create something that's amazing for them, you're going to attract more of them. And the fact is, at capacity, you can't do this for everyone. Those that create more revenue for your business should get a different level of service. So if you haven't gone through and defined this to create a menu of services that tells clients what you do at different service levels to allow them to choose how they want to interact and work with you, that is something that, again, we can help you with. I can get you a template like this. But what I've found is without a menu of services, it's very hard for clients to explain what it is that you do and what makes you different from any other agents, advisors down the street, down the road, wherever it is. But if you've got a menu of service, that helps them to define it. What it also allows them to do is have more control and choice up front. You might be surprised, but when I roll this out with advisors, many advisors and agents are surprised how many clients select a higher tier of service because they want to be in the club. They want to be at the diamond level. They want to get that extra level of concierge type approach. I've had financial advisors we work with that have put this in front of a client, and the client says, oh, so if I roll that money over from this other firm, I can be a diamond level? Yeah. Okay, yeah, let's do that. It just happens. People choose where they want to go. And what you want to do is you want to put the best that you have to offer in front of the clients and allow them to pick. Think of it as if you were a chef and your best dish that you make is the New York ribeye. You'd put that on the menu and allow people to pay more. You wouldn't say, I don't know, that's expensive. Let's just give them the chicken. You want to allow people that ability to choose, because you may be surprised how often they choose something a little bit higher than you would have expected. This also allows you to set the expectations up front. Another study shows that when you take a look at your whole client pool and your whole client base, you're probably going to see that the 20-80 rule rings true. 20% of your clients create 80% of your revenue, but another 20% take up 80% of your time. So when you can set the expectations with clients around, yep, you are at the gold level, this is what you can expect as what you get as working with us. You're going to be able to help people manage the amount of time, the amount of energy that they can expect from you. Again, allowing you to maximize your time attracting and working with those top tier clients that you want to replicate. Now, once you've figured out, these are my top tiers, this is my client service model, you've aligned your values, you need to execute. So this is an example, and this is a robust, this is going to look confusing, but we have examples of client experience timelines that can help you define how and when you talk and connect with clients. It's a lot on here, but together we can define how this works for you. But one of the things that is on here that is incredibly important to manage and to implement is if you're meeting with your top tier clients once a quarter, you should be talking about something different every single quarter. If you have the same meeting with the same agenda every time, that gets stale, that loses value. And the fact is the clients start to think, why do we just keep doing the same thing? But if you change your focus every quarter or every 6 months, that feels new, that feels different, and that feels fresh. That is a different experience than, hey, I do the same thing every time. So how do you, and what is the right amount of contact to have with clients? There's a model that we follow that has worked and that has created the right amount of contact that keeps the right clients aligned keeps them retained, and it keeps them engaged. And for your top tier clients, 12-4-2 is the model. What that means is 12 touches a year. 4 of those touches should be quarterly meetings, and 2 of those meetings should be face-to-face. Now, what is a touch? What I'll tell you is it is not an automated marketing newsletter. It does not count. In this day and age, people are so used to knowing this is impersonal. This is just a piece that gets turned out. This has to be a personalized outreach. It doesn't have to be long. It doesn't have to be a meeting, and it doesn't have to be you. It could be a member of your team calling out, hey, Bernard, it's Brandon from XFA. Just wanted to check in. How's your summer been? Do you have any questions that we can answer for you? No? Great. Well, hey, if there's ever anything we can do, let us know. Hey, Chris, it's Brandon from XFA. How did spring break go? It's simply checking in with your clients ongoing. It could even be an article right now, right? One of the big things is how do we find structured products that fit? One of your team members can call out and say, hey, Chris, Brandon from XFA, I had this really great article about these new products that are actually very popular right now. And we're seeing a lot of people wanting to fit them into their portfolio. I'm going to send you an article on it, but I'd love to hear what you think. Sound good? Great. I'm going to send that email. Keep an eye out for it. That's a touch. It's a personalized call. It's a voicemail left and an email following up saying, hey, check out this article. I thought of you. Let me know what you think. 12-4-2. For your middle tier, just cut that in half. 6 personal touches a year, 2 meetings a year. 1 of those should be face-to-face. And for your bottom tier clients, cut it in half again. 4 team touches a year. 1 of those meetings should, or 1 of those touches should be an annual review. You don't have to do those necessarily face-to-face. That's a model that was put in place probably about 6 years ago, which now makes it even more true today with this don't have to be face-to-face approach that we now have video. We now have a lot more virtual capabilities and people are more used to that. The other thing to think about is who on your team can own creating the rewards and celebration gifts. I bet you have members on your team that really are passionate about creating this amazing client experience. Maybe it's the person at your front desk. Maybe it's your operations manager. I bet there's someone that really enjoys creating, maybe it's you, but if it's not, or if you're busy, find who in your team is passionate about this and give them the autonomy to run and start implementing these approaches and start putting these things into place. As you can start to implement this, you're going to start to see your clients increase their loyalty. You're going to see referrals go up, and you're going to see more and more people wanting to bring others to your practice to find out what you do and why you're different. And that is the key to organic growth. Once you start doing all of this, your referral conversations are going to completely change. They're going to be much easier. You're going to get passive referrals. You're going to be able to find more opportunities that people are sending folks your way. Now, the last thing that I'll share that isn't on here before we go into the action steps totally is a great way to check how you're doing on this is to have a client advisory board. If you haven't done this before, or you haven't had an effective one, we can talk about how do you take some of your top clients and ask them and share with them what you're doing and get their input on what's going well, what could be changed, and how can you continue to speak to and attract people like them. I run these for a lot of our clients, and what we do is we do 1 hour long. I cover the first half hour, and then the business owner comes in the second half to do a different kind of conversation. But what it does is it allows you to get actual input from your top clients on what they would see, what they would like to have to be able to refer you, but it also gets them engaged in your business. If someone gives you advice on how to be better or on how to execute, they are now mentally and metaphorically involved in your success. Their likelihood to refer will go up. Your ability to attract more and more of these clients will continue to rise. So what are the action steps? I'm going to end 5 minutes early. I know it said till 9:45, but what I would say is if you want to implement any of these things, if you're thinking you heard some good ideas, shoot me an email. Brandon@xfa.coach. We do all of our first sessions free. If you like what we can give you and it sounds like we could work together, great, we'll talk about that. If not, we'll send you away with some key tips on how you can start to put these things into place. You're going to get value either way. Just send me a note. Subject line can just say, hey, reach out. And I'll connect with you and we'll get our team scheduled on the calendar. Reach out if you want to implement any of these. The next step, though, is define your team values. I have tools, I have support that I can give you to help you walk through and define the values that you and your team hold dear. Take a look at refining or even creating your menu of services that aligns to your client service model. And the last piece is to execute. Look, we're a little over halfway through January. Tying this into a focus of 2023 is a great way to introduce this to clients. Hey, I'm focused on a great client experience this year. Here's what I'm doing to change that. Here's what I'm doing to make it even better for you. That is a great opportunity to reach out, have a conversation, and provide that value to create a wow moment right off the bat. Take a step. You're spending a lot of time on the session if you were on yesterday. If you're here all day today, a lot of time is going into this. It's an expensive conference time-wise. So go ahead and make sure you're putting some actions into place. Results depend on you not focusing on obstacles, right? If you think about, I don't know if I can do that, this is what'll get in the way, you're never going to be able to get to where you want to go. So focus on the results you can have. Let me know if there's a way that I can help. I'm 100% here to do that. And with that, as I said, I'm going to end a couple minutes early. So Bernard, I'll turn it back over to you, my friend. I'm going to go ahead and stop sharing.
All right, Brandon, thank you again, my friend. And folks, I urge you, reach out to Brandon. I mean, this will really help you out with your practice and your agency. So folks, if you have any questions for Brandon, just go ahead and type them in the Q&A or the chat, and Brandon will be glad to answer them. If not, if you got his email address, you have his phone number, definitely reach out to him. All right, Brandon, thanks again, my friend.
Thanks, Bernard. Good to see you, Chris. We'll talk to you all soon. And
good to see you, buddy.
Hey, best of luck and growth, everyone, in next year. See ya.
All right, take care. All right, folks, now we have the next segment is annuities in today's economic environment. We have Chris DeMARS here with TRUECHOICE Financial. Actually, he's one of our annuity partners here. And I always go to Chris. If I don't know the answer, like I say, I go to Chris, and this young man is an annuity genius. So go ahead, Chris.
Well, I don't know if annuity genius would be the right terminology, but I've been doing this for some time. I'm glad to be here on the call and on this Academy Day 2. I'm sure everything was fully loaded with a lot of useful information from day 1 on the life insurance side. I know my cohort and my partner, Chris Schaefer, did a lot of presenting yesterday. And also one of my former colleagues who I used to work side by side, Brendan HEGG, what a great presentation. Man, to lay a foundation like that and to have that base level understanding of kind of what to do and grow your business. That's awesome. I wrote a lot of keynotes, which I think I'll touch on a little bit, that will maybe help put what he said into kind of some perspective. with some real life examples. But as Brendan said, my name's Chris DeMARS. I'm the VP of Advanced Annuity Sales here with TRUECHOICE Financial Group. We're a partner IMO or FMO, whatever you want to call us, BGA, that they use for their annuity and life insurance business. You know, when Bernard reached out to me and asked to present on annuities in today's economic environment, I thought to myself, how much time do I have? And he gave me an hour, and I was like, man, does this guy think I'm an economist? Like, to spend an hour on? So I dug in a little bit deeper, and I've added a few things to my presentation to make it worthwhile and to provide some value. So let me see if I can't share my screen here. All right, can everybody see? We good, Bernard?
Yep.
Okay.
There we go.
All right, awesome. So again, Chris DeMARS, and so annuities in today's economic environment. He also wanted me to touch on guaranteed income for life. I thought, well, man, I could probably maybe go half an hour with this. So what else can I bring of value? And for those of you who've been on some of the past webinars, I know I've touched on one of our flagship platforms, if you will, which is our retirement roadblocks. And this is really all to help you position annuities and bring value. As Brendan HEGG said, you know, it's all about bringing value, creating why moments with your clients. This platform may not create wow moments, but it'll definitely bring value to you, the financial professional, and helping educate your clients to make that annuity sale, which intrinsically is going to create a significant amount of value in their retirement years. And then we'll finish off with a holistic approach to life and annuity planning. And then I'll bring my partner, who you heard from yesterday, Chris Schaefer, on the line, and we'll talk a little bit about you know, using annuities and life insurance in conjunction with each other. I thought I would take just a moment to kind of explain, talk a little bit about me, my background. I cut my teeth in this business in 2005. I know what you guys are thinking. Yes, I did start when I was 10 years old. But this is my 17th year in the business. I started in 2005 at Allianz Life Insurance Company of North American, which is one of the biggest annuity and life insurance carriers in the country, and then globally, they're the 22nd largest, Allianz, that is the 22nd largest company in the world. And I did that for 6 years, kind of, you know, worked my way through sales to a point where I wanted to get closer to the field, closer to financial professionals, and not be at the manufacturer level or the carrier level. So they had a wholly owned IMO back then, which has morphed into TRUECHOICE Financial Group. So I moved out to Southern California, and I've been there since 2011 with what is now ultimately TRUECHOICE Financial Group, which again was owned by Allianz, and most recently was sold by Allianz this past November to a company that might be a familiar name. It's a private holding company called AmeriLife. They too also have an IMO as well, and then they own other IMOs in the annuity life insurance arena. And collectively, we now are, if not the largest IMO in the country as it pertains to annuity premium or annuity sales. We'd probably be the second, and we're right at about $11 billion in annuity premium sales per year. So that's a staggering number. And I bring that to you not to gloat, but as to say that with that volume of business, the amount of tools that we can bring to IAD and to you to help you grow your business, to help you provide that value that Brendan HEGG just spoke about, to help create those wow moments in your practice, is invaluable when we do that type of volume of business. It gives us the leverage to spend money in those areas, and we'll talk a little bit about that. And one of those areas is the Retirement Roadblocks platform. So with that said, Let's jump right into annuities in today's economic environment. And I'd be remiss if we didn't talk about the market in review from 2022, right? Kind of a crazy time in 2022, a lot of headlines that were popping up, whether it was in financial periodicals, magazines, or your big name newspapers, so New York Post, Washington Post, whatever your big local one there is in the Detroit metro area or whatnot. You know, it's probably not a shocker to everybody on this call. That's how the market was down in 2022. The S&P closed at 3,840, giving it almost a minus 20% 2022 return. So the market was down significantly. I obviously we use S&P as kind of a barometer of the overall arching marketplace because it uses obviously the top 500 companies. When it pertains to bonds, this you may not know, but the overarching barometer to kind of get a good synopsis of how the bond market is faring is the Barclays Aggregate Bond Index, or the AGG is the ticker symbol. And that was down 13% in 2022. And that may not seem quite staggering, right? Compared to, hey, well, gosh, you know, equities in the market was down almost 20, bonds only 13%, no big deal, right? Well, it kind of is a big deal. And such to the point that a professor, I was researching, how to put this in perspective. And Professor Emeritus at Santa Clara University, a guy named by McCory, I found, said you have to go back 250 years and you can't get a worse bond market than 2022. 250 years. I don't have it up here, but later on in that article, basically he was saying it was during the time of Napoleon. Yeah, so that's how bad. Even minus 13% don't look too bad on paper when you're seeing it here up on the screen, but that I think puts things into perspective. And then to take it one step further, when you look at financial planning, right, like certified financial planning models, right, the holy grail for somebody who's quote unquote doing financial planning has always been a 60-40 portfolio split. 60% equities, 40% bonds. We can take a structured 4% systematic distribution, adjust it to inflation. That should always get you through a 30-year retirement. Case closed, no problems, right? Well, with the type of environment we've been in for the last 10 years, I mean, it's shot bullet holes all through this model left and right. A matter of fact, when this kind of modern portfolio theory was developed, it was back in the late 80s, early 90s. So just like anything else, I mean, that's been a 30-year run. In 30 years, I think it's time to retire, right? I think that portfolio split is time to retire. And I think with this data, it'll show that, because if you had that portfolio in 2022, at least through August of 2022, you would have been down 19.4%, which was the worst it's performed since 1936. Now, I wasn't around in 1936, so I can't really have anything to compare it to. But what I can compare it to is the Great Recession of 2007 and 2008. And even through the Great Recession, when you had an equity market that was down just over 48%, and the bond market was down just slightly, you still didn't have the performance that was worse than last year. And we're talking down 48%. S&P was only down 20% last year. This is down 48% 2007, 2008. And then combine that in a portfolio mix of 60-40. Even in the Great Recession, a 60-40 split didn't perform that bad. So that kind of tells you, kind of the trials and tribulations that we went through last year in 2022. And of course, another huge hot button that was on all the tabloids, all the financial periodicals, inflation, right? We all felt it. We cringed when we went to the pumps in the middle of summer last year, where I think it hit its worst. It's, oil and gas prices have tailored off since then. And, maybe outside of California, I think we're back to averages, especially in your marketplace there in the greater Detroit area. Here in Minneapolis, where I'm at, I know gas prices have come back down to, a national average price ranges. But let's take a look at, I think, well, one area that hasn't come down, and that's groceries. I think that's where my wife and I probably feel it the most, especially with a 9-month-old. I can't go to a grocery store just to pick up, things that we run out of on a weekly basis. So our weekly run to Target, a Super Target, or a grocery store, just odds and ends. I mean, $100. I don't think I've ever escaped Target less than maybe 75, and that's just for a handful of items. So inflation's been huge, right? And so it's expected that that's going to come in. It hasn't been announced. It's going to be announced February 14th. What a day to announce the inflation rates for 2022. Yeah, February 14th. They think it's going to be about 6.5% is going to be the CPI for 2022. Of course, in other news, federal funds raised rates 425%. It seemed like I think there was about 4 times that they raised rates throughout the year. It started the year at 0 to 0.25%, and by the end of 2022, it was at 4.25%, 4.5%. So obviously, that had a lot to do probably with inflation. It had to happen. I don't care what side of the aisle you're on. You can't just keep on, pumping air into the bubble that we've created probably, all the way back to the start of, the Bush administration. So, regardless of what your politics are, we had to have rates come up eventually. And so last year was the year that they did that. And then crypto, commodities, alternative investments. Why do I bring that up? One of the reasons why I bring that up is, we hear this, non-correlated assets, right? Bonds are supposed to be the big non-correlated asset, right? If you look all the way back to the beginning, of the 30s, when, the equity markets really gained notoriety, S&P was created, so on and so forth, right? Any recession that we've had or any pullbacks in the market, right? You could always count on a quote unquote a non-correlated asset to position your assets there to stave off any losses in the market, right? Well, not so much, right? We already saw bonds were down, the S&P was down, the market was down, bonds are down. I don't know if any of you guys have looked at or entertained the idea of buying crypto. That's getting slaughtered. And I just listened to a Joe Rogan podcast with a gentleman on there that didn't really have anything warm and fuzzy to say about crypto. Matter of fact, he said that probably in the next year, you're going to see Bitcoin go to negative 1,000. That's not what, don't take that from me. That's not my quote. This is just what this other gentleman said, who's by far a lot smarter than I am. But crypto was down. Commodities weren't quite down so far. They made a good run about middle of the year. They're up significantly. And then the last half of the year, gold particularly dropped pretty heavily. I think they ended around about -3%. So again, another non-correlated asset that moved with the market. And when I say moved with the market, it was down. Alternative investments, you guys are probably going to laugh at me, as sports cards, right? Yeah, I'll age myself here, but I was heavy into sports cards in the 90s as a little kid. And I got back into it because the craze really resurfaced in COVID during 2020, because nobody had anything better to do and people were getting free checks in the mail. And what better thing to do than go back to their childhood memories and collecting sports cards. But the sports cards even have a S&P 500 style barometer, if you will, and that was down. So overall, whether vintage cards, modern or ultra modern are kind of like the three categories in the sports card market, that was down. NFTs down, and just a lot of alternative investments. Pretty much everything was down. So again, this whole idea of non-correlated assets failed for the second time in my lifetime, and I think the second time in the history of the marketplace. The first time being the Great Recession. And then the 10-year Treasury. That closed at 3.88%. It started the year in 2022 at 1.77. It peaked in October at, what was it, 4.23%, and then kind of tailored off at the end of the year, and again closed at 3.88%. And why do I bring up the 10-year Treasury? One of the reasons why I bring this up is this is, generally speaking, you can tell how strong annuity products are going to be based on the 10-year Treasury. Most annuity products are built on a 10-year chassis. And so therefore, one thing that most people in the industry are going to look at to see how strong annuity products are going to be and how they're going to fare in any given year is going to be based on the 10-year Treasury. Now that's, a very oversimplification. There's much more into it that goes into the pricing of annuity and how rates renew and whatnot. But from a high level, looking at the 10-year Treasury is going to give you a good idea of how strong the product annuity marketplace is going to be. And so with that, let's take a look at 2022 from a macro level in annuities. LIMRA, who puts out this data, they don't have the final numbers for the full year of 2022. So the most recent data is through the third quarter that I have here of 2022. And in the third quarter of 2022, FIAs, fixed index annuities, hit a new record of 21.4 billion, which is a 25% increase over Q3 of 2021. And year-to-date totals through Q3 of 2022 was 57.4 billion in FIA sales. Furthermore, it's kind of at a surprise because I've never seen this in my 17 years in the business, but fixed rate annuities, mainly multi-year guarantee annuities, MYGAs, reach staggering numbers. And part of that is due to distribution. There's just more distribution channels, especially when you consider through banks and other areas where a lot of indexed annuities don't have those open distribution channels, is why we're seeing such large numbers in the multi-year guarantee annuity space. And that, even though it comes at a little bit of a shock to me, it shouldn't, based on the numbers that I just showed you when it comes to the Fed funds raising rates and then the 10-year Treasury, right? Interest rates are just up in general. You've probably seen it at your local bank, and bank CDs are even very competitive, especially the shorter term ones in nature. But fixed rate annuities, Q3 sales, 29.8 billion, 159% increase over Q3 of last year. And then total fixed rate sales through 3 quarters of last year were 74.4 billion, which is a 77% increase year over year. And it wouldn't be a complete conversation if I didn't mention variable annuities. So I have RILA sales up there, which has probably been the fastest growing marketplace or segment of the annuity market space. And if you carve that down to even variable annuities, clearly the fastest growing in the variable annuity space is RILAs, which stands for Registered Index-Linked Annuities, also called IVAs, Indexed Variable Annuities, Buffered Annuities. There's many different acronyms that they go by. But I think the one that the industry is gravitating towards is RILA sales. And those improved Q3 total sales through Q3 of 2022 was 30.9 billion, 9% higher than the prior year. And really the lagger of the bunch is variable annuity sales. And that probably comes at no surprise since the market was down. Traditional VA sales were down 37%. Total sales in just Q3 alone, 13.7 billion. And then through Q3 2022, 48.5 billion, which is down 25% year over year. And one thing that I find very interesting about this is that when I got in the business in 2005, I mean, if you look at all these numbers up, right, the annuity market space is probably about 200 billion, right? Maybe a little bit more, maybe a little bit less, but let's just call it 200 billion. And when I started my career in 2005, the variable annuity space occupied about 175 billion of that. Think about that. If we just forecast out based on that last bullet point here, the variable annuity market space for 2022 probably is going to finish around 60 to 65 billion. And it was 175 billion just 17 years ago. So the tides have really turned. And that has to do with just the way they're pricing. And of course, when you're in a variable annuity, your money is directly correlated into some type of market indice. So I rearranged this a little bit. So I'm going to jump right into guaranteed income for life and why that's important. I want to start with, I don't have it up there, but I was just thinking about this, and there's studies that have shown, and I think Time Magazine wrote an article on this. There's been many different talking heads that have written about this, and guaranteed income. People that have guaranteed income, studies have shown that their longevity increases. I mean, just think of the psychological impact knowing that you have guaranteed income for life. I mean, first, let's just think of an event being retirement. The day that you no longer have a paycheck coming in from your employer. So to replace that with a different style paycheck that you can have that comes in every single month, think about the psychology there. And knowing that you have that paycheck coming into your bank account, well, 2023, right? It's probably coming in EFT, so probably not getting an actual check. But to know that that's coming into your account every single month, studies have shown people that have guaranteed sources of income tend to live longer and happier. So think, who are those people who are living longer and happier? Well, who gets guaranteed income? Who still gets pensions? Police officers, firefighters, school teachers, librarians, government officials, people who have a pension, right? Those are the people who are living longer and living happier. And it's no surprise because they don't have to worry about where their next paycheck's coming from, right? They don't have to worry about how their stock portfolio is doing and, oh, should I take an income this month? I mean, think about if your level of your retirement quality of life is $100,000 a year and providing income, and you have this big nest egg, let's just call it $1 million, and now your $1 million is down 20%, so it's 800,000. Do you say, well, you know what, I'm going to forego my income, I'm going to stop paying my mortgage or my rent or my gas or my electricity or any of those things, right? No, you can't. You don't have that luxury to just pause that. So now you got to take an income from that asset. And let's say the quality of life or the level of retirement that you want is $100,000. Now you got to take 100,000 from your 800,000, and now you're at 700,000 in 1 year. So having a replacement for guaranteed lifetime income is critical. And the only investment, quote unquote, it's not an investment, it's an insurance contract issued by an insurance carrier that can give you guaranteed lifetime income is an annuity. That's it. And so, maybe we don't have to call it an annuity. There's many different lexicons. We can call it life income insurance or retirement insurance, whatever you want to call it. If, now I would say today's times have changed, right? We're not living 20 years ago when I first got in this business, and annuities were a 4-letter word, right? You said annuity, people were like, ooh, those are bad. We don't want to talk about those annuities. Those are really ugly. And then you tell them, all right, great. So let's set an appointment when you turn 62. We're going to call the Social Security Administration office, and we're going to tell them we don't want those ugly annuity paychecks. oh, those are bad. Social Security, it's bad. That's what Social Security is, right? It's an annuity. That's all it is. It's just run by the government. And so another lexicon that we could call an annuity is, I have it right there. We can call it a private pension, because essentially that's really what it is. It's not by the government, it's by you, and it's a contract between you and the insurance carrier. And how they're able to give you guaranteed lifetime income is they're pooling risk, right? These insurance carriers have some of the brightest actuarials, math scientists in the business, in the world, that have figured it out to a fairly degree of certainty on both ends of the spectrum. There's going to be people that are going to die early. There's going to be people that are going to die right on time. And then there's going to be people that die later, right? Past maybe their life expectancy. And they've got that down to a science on the math and how that's going to work out. And so that's how they're able to give you guaranteed lifetime income by providing you mortality credits, right? So if somebody dies early, that's a credit that's added to the system that can get paid out later in life. Now, don't think by dying early that the insurance carrier keeps your client's money. That's of course not how it happens. Whatever's in their account goes to their beneficiaries. There's no probate, nothing like that. Again, another oversimplification, but they're just doing mortality credits. And then most insurance carriers are also on the other side of the equation on life insurance. So, everybody thinks life insurance is good, right? It's just, an annuity reverse engineered, or the opposite, right? So life insurance, you pay monthly premiums, and when you die, it pays out a big paycheck to your beneficiaries. Just the opposite of that, an annuity, you put in a large chunk, call it a 401k or whatever type of investment portfolio you've put together through your working years, and you do a transfer, a rollover into an annuity, and then it distributes monthly income for a certain period of time. For this sake of this conversation, we're going to talk about guaranteed lifetime income.
Hey, Chris, I actually have a couple of questions for you. Yep. One is, could you please touch on fixed rate a bit more?
Fixed rate, like fixed rate products?
Let's see if you can, Tammy, if you can be a bit more specific on the question you're asking.
Or like the Fed funds rate, treasuries, the fixed account in indexed annuities, or just traditional fixed products specifically?
Okay, well, we'll wait for her to type in that response. But then question from Jeremy. He's like, can you use guaranteed lifetime annuity to extend to income on a non-spousal inherited IRA, i.e. receive income after the 10-year distribution time frame is over?
Yeah, so the when the Secure Act, the original Secure Act went in force back in, was it 2020? Basically, we still have a few carriers that will allow you to do non-spousal inherited IRAs. However, there's a limit, which I think was aforementioned, 10 years. You can't that's what our lovely government officials had put into regulation. So now we're kind of stuck with that. There's no longer the the lifetime distribution payouts that have to be paid out in 10 years. So so even before then, you can never use a guaranteed lifetime income for an inherited IRA, because as it states, you could only take your RMDs out of an inherited IRA or beneficial IRA for what the IRS was their life expectancy tables. And of course, guaranteed lifetime income doesn't abide by those tables. It just abides by how you live to 110, and that income's still going to go because it's paid by the insurer, right? So there was always some limitations there, and that's one of them, that even prior to 2020, you couldn't use an income guaranteed lifetime income rider for an inherited IRA anyways. So hopefully, I think that answered that question.
But here's Tammy's response: fixed rate products and how they could benefit an investor in the times we live in, given that interest rates continue to rise over the next year.
Yeah, so you know, it's a great alternative, right? I mean, I'm not gonna lie. You know, you're limited on your upside, but then it's a sure thing. And right now, you know, you can get you know, a 5-year multi-year guarantee annuity, you know, in the low 5% right now. That's guaranteed for all 5 years. I mean, who wouldn't want that? You know, indexed annuities really, you know, when you look at how they're constructed, you know, when we were facing some of the lowest interest rates in U.S. history, lower than even the Great Depression, at one point, I think that was back in 2013, 2014, right? I mean, you couldn't get rates the way they are today. And now that rates have increased, you know, who wouldn't want, and the pricing of index annuities back then, I mean, the actuary expectation for these insurance carriers were for indexed annuities to do 3 to 5%. Well, it's like, well, heck, if I'm only expecting that out of my indexed annuity, you know, back then, right? Now we're expecting probably more around that 5 to 7, 4 to 6, 5 to 7 with the way rates are. Who wouldn't want to take, you know, 5.25 guaranteed? So there is some attractability, especially in a portfolio. Most of those multi-year guarantee annuities will either allow you to take the interest off the top, so you can use it from like an income play as like a bond alternative, right? A lot of bonds, right? They're just skimming the growth off the top and keeping the preservation of the asset there. Obviously, in a rising interest rate environment, that affects the bond accounts. But if you have, you know, coupon bonds, you can still clip whatever the interest rate is off the top and use it for income. A lot of, you know, CFPs, financial advisors, yada, yada, yada. That's what they use bonds for, was for what they call fixed income. So this could be a great tool to do that with a MYGA. And now you've got not only tax deferral, which you don't get from bonds or from a bank CD, but then you've also got the safety. You've got free withdrawal options. Like I said, some will allow you to take a free withdrawal in the form of just interest only. So whatever your interest rate is, you can skim that off the top, keep your principal protected. Other products will allow you to take up to 5 or 10% free withdrawal. So many ways that you can use that. And I would say for TRUECHOICE, last year, we probably sold more fixed rate annuities than we have in my entire time working for the company combined, just in last year, because of the rate environment that we find ourselves in. So great question. It's a great tool to have in your tool belt. One of my top advisors, he's sold more fixed rate annuities than he has in his career last year, but he liked to do a split. So, you know, if he had 100,000 and the client was interested in just taking a fixed rate, maybe he might split that and do 50,000 in a MYGA and 50,000 in an indexed annuity. Now he's got a short term and a long term, because the one thing that you also have to keep in mind, I'm probably going off on a little bit of a tangent here, is that think about your renewal risk. So nothing's without risk, right? And so renewal risk is in 5 years, since you didn't go with a 10-year FIA or what have you, you know, what will the interest rates be in 5 years when it's time to re-up, right? Whether that's keeping in the same product or transferring it into a different annuity. Either way, it's going to be a new interest rate. Our interest rate's going to be down in 5 years. I don't know. Are it just going to be flat, the same? Or are they going to be up? So there's also that renewal risk that now has been introduced into the conversation. So just something else to think about. But overall, yeah, it can be a great tool in an overall portfolio. And where I like it, just to add, you know, one anecdote to that is for whatever reason, a lot of clients, they have this love or infinity for bank CD rates, so much so that usually they never bring them up. Even some of the top financial professionals that I work with that do, 20-30 million dollars a year in annuity business, and they put together full financial plans, and they do this, and they create the wow moments that Brandon talked about, and they've created raving fans in their client base, this, that, and the other. Even their top clients sometimes won't tell them that they have a bank. There's just this weird relationship that people have with their bank CD. It's like, oh, it's at the bank. That's separate. Those aren't investments. So where I see those multi-year guarantee annuities come into play is just ask your clients, do you have any bank CDs? Because right now they're not getting, well, especially if they haven't renewed, they're probably earning next to nothing. And we can get them tax deferral. You can get them free withdrawals, which you're not going to get in a bank CD, right? They're not tax deferred. You're going to pay taxes year in and year out on those, and you can't take any free withdrawals. So not only can we get them a better interest rate, but we can get them those better features as well that makes them a little bit more flexible and not so rigid like a bank CD. All right, any other questions? Those are good questions.
Oh, she said, thank you.
Oh, yep, not a problem. Last on the list here, internal rate of return. I mentioned this because we're talking guaranteed lifetime income, and if we're talking guaranteed lifetime income, we can't have that conversation without mentioning internal rate of return. And as a shameless plug, we just added a calculator to the extensive list of calculators that we have, and it's an internal rate of return calculator. And really, internal rate of return takes a look at income generated over time and then calculates an equivalent rate of return that would be needed by a different asset. And this definition that we created, this proposed asset is an annuity. And I would like to say, well, no, not an annuity, because we're working with the annuities. That's what we want to implement in the retirement plan. But what would an investment portfolio have to do as an average rate of return year over year, including the distribution of income from that portfolio, to match an internal rate of return of what an annuity can give you? And from what I see, that's a tall task to ask of somebody who's managing a portfolio using the Monte Carlo or modern portfolio theory with a systematic withdrawal down. If they want to have any type of high success rate, and I would say, anything north of 90% as a success rate, you're going to be hard pressed to beat the internal rate of return of what an annuity can give you over 30-year retirement horizon. And we've again created a calculator that's out under tools and calculators, which we'll get into some more calculators next when I talk about our retirement roadblocks platform. But as you can imagine, as we kind of transition a little bit here, when you look at a market that's as big as, well, not only the financial services industry as a whole, but then our little sector, if you will, of the annuity space. As I mentioned, it's probably about 200 billion, maybe a little bit, I would probably say even more than that, market space. And when you talk about that kind of money, right, it's going to get pretty noisy with the amount of information that you're going to have access to. Just think of all these brands that you see here that are blogging, writing articles on Yahoo Finance or Bloomberg or publications, you name it. All these big players, right? They're jockeying for to give the consumer education, which of course then they want their business. And if you add insurance carriers and big banks to the mix, it gets even noisier, my friends. And if we want to lend an ear to Google, Google has all the information, right? Because that's probably where 99.9% of people are Google searching retirement planning. Matter of fact, if you run a Google search for retirement planning, it'll generate 345 million results in a half a second. These are all companies that are jockeying for your clients' dollars. So clearly there's a void to fill. People are searching for education, right? They're looking for it feverishly. Google says financial planning and management searches are up 70% in the last 2 years. Savings advice up 15% in the past year. And most consumers are looking at 3 different areas, which is retirement planning, managing their investments, and what products are out there. What investment vehicles are the next thing that they can invest in. Hate to say it, but they're probably looking for the get rich quick investment option, which, of course, there's no silver bullet. But people want a trusted financial professional. Clearly, by these search results, they need to be educated. And when we dig a little bit deeper, we look at some of the desires of these people and who are interested in working with a financial professional have this to say. They need a financial professional because they need investment strategy advice on their retirement savings and how to withstand market volatility. Clearly, that's the leader in what type of information and education that these consumers are searching for. Second to that is determining how to best draw from investments in retirement, minimizing taxes, and then a little bit further down there, what you guys do best, picking out the best Medicare plan and Medicare supplements, right? So naturally, this is where, I come into play, Bernard comes into play, TRUECHOICE Financial Group comes into play, is, you guys got that down, right? But clearly there's an opportunity that you folks are missing out on, and that is by giving retirement income planning advice. It's the top 2, right? Your clients are saying this. So the proof is in the pudding. So you have what customers want. Now, we ran across this little bug in 2020 called the novel coronavirus that really kind of changed the game for everything. It changed how we approach the business. It changed how all businesses approached. And obviously there was winners and losers during 2020 in this new COVID environment that we were thrown into. And obviously Amazon and Netflix were some of the bigger winners. And then we saw 2 companies, big name companies that were really laggers in the very beginnings of this, but pivoted quite fastly, which one was Target Corporation, right, with their new drive up services, and then obviously they started their Shipt to match and rival that of Amazon with speedy delivery, and so they were able to pivot out of that and be a major winner during 2020 and the pandemic. And then also Uber, right? Their ride sharing services suffered severely because you couldn't go anywhere. There was nowhere to go, but people still needed to eat. So they pivoted again and spent most of their attention and focus on their Uber Eats delivery service, which if any of you are like me, my wife and I definitely took full advantage of that during the pandemic. And then of course there was some who were major losers, the airlines industry, the hotel industry. Thank God they're big enough that they were able to survive that. But the ones that are probably hit hardest was the fabric of America, which was the small businesses and especially those of the restaurant industry. Even the mid to larger size restaurant chains Some even closed down. So just because of your size didn't really mean that you were immune to it. And in just the Twin Cities here, 94 restaurants closed in 2020. So what did that do for the financial advisor? Well, it brought on a new normal on how we had to operate our businesses, right? I look at our two top advisors at TRUECHOICE Financial Group. They do, the last 3 years, they did over 100 million, just two guys. They don't have a team of agents or advisors underneath them. It's just those two guys. They have a paralegal and a couple assistants to help them with new business, and that's their office size. And they do that volume of business. So what they did in 2020, they're used to doing face-to-face dinner seminars. Obviously, restaurants are closed, and you couldn't do anything really face-to-face anymore in 2020. So what did they do? Well, they had to pivot, right? So they switched to web seminars. They doubled down on their radio shows, and then they started TV show. So just like any, great thinkers or some of the biggest businesses that were ever built during the Great Depression, right? They saw where a lot of people saw, excuses or obstacles, as Brandon mentioned, right? Obstacles, what did he say? Forget the terminology he said, but a lot of people saw obstacles where they saw opportunities. And they just doubled down on those opportunities. And in 2020, they did 102 million in new business, and 99% of their client meetings were via Zoom. So they pivoted, and instead of becoming a laggard, they became ahead of the game and became a winner of 2020 because of some of those moves. So now as we come, obviously we're still in this, I would say, COVID/pandemic era. I mean, maybe some would say we're on the coattails of it, but if you look at anything that's happening in China, they're seeing a resurgence of, 3 or 4 different new strains and lockdowns again and whatnot. So I would venture to say that we're in a new normal now on how we do business. And I would say a lot of financial professionals are, doing business in this kind of hybrid model. So some have gone back to face-to-face appointments, going from the web seminars or webinars like we're on today for client prospecting back to in-face workshops or dinner seminars or educational events. But I would say a lot of them, because of the convenience of being able to do this right in front of your computer screen in the confines of your own office, have done a hybrid model. So something to think about as we move forward, and how you can provide that value in whatever model that you decide, whether it's in person or virtually through the computer. Our retirement roadblocks can take you there. And in Retirement Roadblocks, we explore the 7 financial risks to avoid while preparing for retirement. And we have our lovely Bill and Jill to help guide our retirement discussion today. And Bill is big brother Bill, and little sister Jill will help us take us down this retirement journey as we look at all 7 facets or 7 roadblocks, if you will, or 7 risks that inevitably you'll encounter, probably multiples of these risks in retirement. And why we put this together was really to provide that education. As we just saw, all the different companies that are jockeying for your client's attention, your client's dollars, there's a lot of complexity. And we wanted to provide something that could be educational and remove some of the complexity and bring more clarity to the retirement conversation. Make it more approachable, not dumb it down. Your clients aren't dumb, right? But we just wanted to make it more approachable, more educational. And this is something that we wanted to focus on, bringing value to you, the financial professional. So what are those 7 risks to retirement? Well, you've got longevity, which if any of you have heard Tom Hegna, this is a risk multiplier, meaning that the longer you live, the more you're going to run into one of these other 6 risks: inflation, sequence of return risk, withdrawal rate risk, healthcare risk, social security risk, and tax risk, right? I mean, it's kind of a no-brainer, right? The longer you live, you're gonna eventually be impacted by, for sure, one of these, probably multiples of these, if not all of these in retirement. And what's beautiful about the Retirement Roadblocks platform is that it's product agnostic. You don't see one of the risks as annuity risk or life insurance risk or Facebook stock risk or mutual fund risk or anything of that. So no matter what your business makeup is, if you're doing equities, if you're doing just insurance, what meds up, look at that. We got healthcare. That might be one of the risks that you can leverage from us right away as you're starting to get accustomed to some of the other risks that may be pertaining more towards retirement planning. I mean, obviously healthcare risk is part of that, so I have it here, and has a lot to do with some of the tools that we have. But just again, just one of those risks that might, that you can leverage right out of the gate. So let's take a look at kind of our wheel and spoke model, if you will. And at the center of the wheel is our consumer guide. This is really the heart and soul of the Retirement Roadblocks platform. This is where you'll find all 7 of the risks bundled together in one brochure. This is available for purchase. We do have, we use a printer that prints these out. These are very nicely done, binded together booklets that goes through all 7 of the topics and can even be customizable with your name and logo, and we'll talk about that a little bit later on. But we pass our savings on to you. We're not looking here to profit on selling these to you, so we cut you the same deal that we get from our printer. So you're able to buy them in lots of 25. But we also have this available to you in PDF format too. So if you want to start there, start small, by all means, we can get you the consumer guide. You can print it out on your own printer if you want to. It really doesn't matter to us. We just want to bring that value to you. And then surrounded by that are the spokes to some of the other tools that complete the Retirement Roadblocks platform, tools that we're going to cover one by one. As we look at the consumer guide here, again, a closer look at that. Again, healthcare risk, withdrawal rate risk shown there on the screen. And then we covered the other 5 as well in this brochure. As I mentioned, again, available in PDF or print. Then one of the spokes that we saw here was around animated videos. We here at TRUECHOICE Financial Group have a team of that's called TrueCreative. That is our in-house advertising agency. We've spent millions of dollars building this out. I don't know of any other IMO in the entire country that has an actual advertising agency within their IMO. We do, and we leverage that severely. And this is one of the ways, obviously this platform in itself is just one of those ways, but even looking closer at like an animated videos for each of the 7 retirement roadblocks, we've created about a 3-minute animated videos using cartoons. I mean, who doesn't like cartoons, right? I know growing up, my favorite cartoon of all time was Scooby-Doo, and heck, I mean, look at even today's, we've got adult cartoons. One that sticks out to me is South Park, and who knows, maybe we've got some South Park people here, but in any event, it's approachable, right? And these are educational videos. And why we chose the cartoons was, again, to make it approachable, make it educational. They're again, not offensive because we're using cartoon caricatures and it's lighthearted. And these animated videos are used in a multitude of ways. And I would probably say, of all the tools within retirement roadblocks, this is probably the most widely used of all of our financial professionals. What would be a platform without some sort of consumer presentation? When we thought about building this platform out, we thought, okay, what do most of our financial professionals who are doing marketing or who are doing prospecting to get new clients in the door, what are they doing? And a good majority of those financial professionals are using consumer presentations in the way of workshops, dinner seminars, just educational seminars, you name it, whatever you want to call it. They're getting in front of a good quantity of people on a weekly or a monthly basis. And so we thought, well, we've got to put together a consumer presentation. And so whether you're going the older model, the pre-COVID model, so to speak, which again, people are getting back to that face-to-face presentation, we've got one dedicated to face-to-face, and then we've also built one dedicated for just a web presentation as well. Both options come with the whole lineup of A to Z of everything that you would need to run any type of seminar, if you will. So it's got the invites, it's got the evaluation forms, it's got the handouts, everything that you need complete, bundled up in a consumer platform.
Hey, Chris.
Yeah.
Just for essence of time, I mean, retirement roadblocks is actually one of my favorites, and don't want to diminish that, but we got to kind of move it on a little bit. But folks, I mean, Chris, we can set up a webinar solely on retirement roadblocks. I mean, folks, this is a great tool that you can use with your clients, individual meetings, as well as seminars, as Chris was talking about. And what it takes for us is, you get appointed with a few of our key annuity carriers, life carriers. We can get you access to the retirement roadblocks through TRUECHOICE, and then we can go from there. Do it that way.
Yeah, for sure. All right. Well,
yeah.
my apologies, Bernard. I thought I had until 11. My bad. So let's bring on Chris Schaefer then. As you probably saw some of this stuff, but yeah, I hope Chris. Yeah, I see Chris is on the line. So let's talk about how we can use annuities and life insurance in conjunction when looking at building a plan for retirement. And we wanted to show you two different scenarios. And now keep in mind, we really kind of dumbed these scenarios down simplified it as much as we can. You're never going to find a scenario that's just, 60-year-old female, 300 in 401k and 300 in household investable assets, right? They're probably going to have maybe a business that they own. They might have a pension. They might have, multiple 401ks from multiple jobs. They might own investment properties. Their balance sheet is going to be more robust than what we're presenting, but we just wanted to get this idea of, how might you move one of those assets into an annuity and life insurance to help them start their retirement journey. So again, we used pretty much the same scenario in both scenario 1 and 2. It's just how we position the annuity and the life insurance is going to be a little bit different. So in this particular scenario, we're going to roll the 401k into the annuity and life insurance. We're going to put 200,000 into an FIA, 100,000 into a 5-year SPIA. So we added a little something into the mix, another sale. So again, more revenue for you, the producer. And then that 5-year SPIA is going to fund a 5-year life insurance contract, and Chris Schaefer will tackle that. So what I did was I used American Equity, the Income Shield 10, We put 200,000 from that 401k rollover into an IRA. We used again the American Equity Income Shield 10, starting income at age 65. And then we used the other 100,000 and we funded the 5-year SPIA with Corebridge, aka AIG. And so let's take a look at what that looks like on the FIA side of things, providing guaranteed lifetime income. So we put $200,000 in. You're going to get a 10% bonus right out of the gate. So you see the initial premium bonus, 20,000. So we have $220,000 that's going to grow at 7% compound year over year until the 5th year. Well, after the 5th year and start of the 6th year, when they turn age 65, will spit out an income of $18,514. That income is guaranteed for life. Remember, mortality credits, pooling risk. You don't have anything to worry about. That's an insurance contract. This will pay them until their last breath to supplement whatever income gaps that they have in their balance sheet or in their budget, if you will. Now, of course, again, an oversimplification. If you have a specific scenario where you've done a budget and you've found out that, you know, what their plan for their retirement quality of life is, I don't know, 60,000 a year, and they get 40,000 a year from Social Security, so they've got a $20,000 income gap a year. You know, this would probably fit that, right? You're almost at 20,000. But if it's a smaller income gap, we can back into that and work and play with the numbers to figure out, you know, what's going to be a reasonable amount of retirement income that they'll need to live a full and happy retirement. Whoops, there we go. Step 2 is the SPIA. So instead of just putting the 100,000, you know, right into you know, a single dump in, it often works best to use a medium to pay into and fund a life insurance contract. And for this, we used the AIG. They just did a name change now called Corebridge, which is still under, you know, the AIG umbrella, so to speak. But we used a 5-year certain, and that's going to kick out $19,864 a year for 5 years and fund a life insurance policy, which I'm going to now turn over to Chris Schaefer to take a closer look at that.
Hey, thanks, Chris. I appreciate it. Am I able to be heard?
Yep, we can hear
All right,
you.
just wanted to
And
make sure.
stop sharing my screen, so if you want to pull up your end of it.
Let me know if this is able to be seen. All right. So everything that Chris went through, again, kind of confusing because we got the double Chris's here talking, but the deal is this. You could always just stick everything in the annuity, use that as part of your plan, or you could look a little bit further into some of the impacts or some of the things that could happen in the future, right? And like Chris said, every situation is different. And we're assuming here that we're able to take the 200,000, stick it into the annuity, and that's going to be enough income for them to get what they need. Now, the idea is that separate sale that he spoke about on then putting some money into the SPIA is that we're going to pay some taxes today, okay? Now, let's keep in mind some of what we talked about yesterday when I was on here about taxes and how taxes could impact future income and what's going to happen there. So when you think about this, if we put it into a SPIA, we can pay it out and fund it into that IUL plan. And so what I did here and what I'm about to show you is how that can benefit you on the back end, okay? The idea here is being able to give an additional bump on your income on the back end that's not going to impact your taxes at all because we already paid the taxes on the front end. Now remember, we're paying it on the front end because right now we're in a historically low tax environment. It behooves you to clear some of those taxes off today. So what does it mean for you, right? Well, when we look at how that IUL will pay out to you, okay, really pretty simple here. We got a taxable asset versus what the life insurance is going to do. Okay. And if we look at a 5-year SPIA that's going to pay out $19,864, and we show that as a contribution into the insurance, okay, we put a growth rate on that of 7% on your taxable asset. When you look at the life insurance, I'm just mirroring it. And we're going to get the life insurance as well, right? $206,000. So here's the first part of this that I want you to know. Your annuity that you have that's paying out your initial income that had $200,000 put into it, when somebody passes away, I don't know how Chris set that up, if it's going to continue to pay out to the spouse or if there's going to be like a full cash refund or what there's going to be. But the first idea here is we now created a death benefit on this side of $206,000 to replace that $200,000 in that initial annuity. And this money is going to go on to the heirs tax-free. Okay. We essentially doubled that money to get it to be used twice when looking at it like that. But now if we compare the fact that, hey, this person lives a long life, and what I did was I put the money in here and we went out to age 73. Age 73 is the point that we have required minimum distributions that come out. So this is where I wanted to show the income coming out. The life insurance has the ability to pay you an additional supplemental income of $13,872 that'll be tax-free. That is now able to boost up your income. We were getting $18,000 before. Now plus another $13,000 after inflation and maybe taxes are digging into that payout. We just added $13,800 that's completely tax-free. Now, what does that look and what's the actual benefit? Well, if you consider taxes in this equation, and we say that this person's in a 25% effective tax rate, to equal this $13,000, they're going to have to get a payout of $18,496, right? But that's going to then be taxable. So if we look at this right here, what we're going to see is when you compare this to something that's taxable, and we're not comparing this directly to the annuity because the annuity is going to pay for life, right? This is the idea of if you kept some of that money in the bank or you had it invested. But that money is going to run out in 12 years where that life insurance is going to continue to pay to your age 100. It'll end up paying out $388,000 tax-free. Okay. If you look at the alternative of using, an income fund or investing and pulling money out or just going in the bank and using a CD, you're going to run out of money at age 85, everything being equal, and you stand to lose over $200,000 after taxes and everything. And if we did end up using this life insurance idea, that's going to give tax-free income, and the person did not pass away and we ended up taking the income out of it. At age 100, like I said, you would have gotten $388,000 and you still have a death benefit of a little over $46,000, just shy of $47,000 tax-free. So that $100,000 that we moved over here, okay, is going to ultimately turn out to be worth, okay, I'm going to do the math, $388,416 plus $46,887. That's going to be worth $435,303 of tax-free money for yourself while living, and for those left behind when they get that death benefit that's paid out. So what I really wanted to hit on with you guys is the idea that, hey, let's think outside the box and let's understand that planning is a lot more than just let's take a CD and move it to an annuity. Let's take a CD and have them get a higher rate of return on it. It's much more than let's just take a 401k and roll it over into an IRA. Let's think outside the box and let's take the lessons and the principles that we know. Taxes are going to go up, right? if somebody's paying in a 20, 22%, 25% tax bracket today, if they pay those taxes today versus waiting and paying, and now they pay in a 28 or 30% bracket, they're saving money by paying it today. And we're also able to take some risk off the table. And we're then able to protect the value of those annuities as well, because we got the death benefit over here. So don't look at this and say, hey, this is for this perfect individual or whatnot, right? Because we tried to make this up. I really wanted to get across the idea of think outside the box, take it step by step, but think bigger than just moving from one account to another. So that's one idea right there. Now, I think Chris is going to pull something else up. If I'm correct, are you going to pull something else up now, Chris?
Yeah. Yep. So very similar. I'll switch here.
Do I need to stop sharing for that to work for you?
Nope. I'm able to do it. There we go. Did everybody see this? So we got scenario 1 there. Let's see here. Scenario 2. So again, same 60-year-old female, 300,000 401k, 300,000 in household investable assets. This time we're going to focus on the 300 in household investable assets. So we're going to roll that non-qualified investable assets into an annuity and a life insurance plan. This time we're going to do 225,000 into the FIA, and then 75,000 into the National Western Lifetime Return Select. For the FIA, I use the Athene Ascent Pro bonus, starting income at age 65. We're going to use option 1, which is the roll-up of 10% simple year over year, plus you get a 25% bonus. And then I elected the increasing income. As we already talked about, one of the major concerns and one of the biggest headlines of 2022, and I think also in 2023, everything that I look at is inflation. So how can we stave off inflation? Well, one way is by keeping up with it, first and foremost, and having a COLA, cost of living adjustment. And that's what this product provides you, is the ability to have increasing income by following an underlying index in this indexed annuity. And so as you can see, if you remember, on scenario 1, we use the income shield with American Equity. In this scenario, or that scenario, it was a static income. Higher income, albeit, right, at age 65, I think that kicked out 18,000 and some change. So now we're going to start a little bit lower at 16,144, but based on historical representation, it shows that our income can grow each and every year. So if I look at, you know, at the bottom here at age 85, oops, that just started. At the bottom there at age 85, your income has grown to 61,879 a year, with the total payout already in just what, 25 years, 24 years. We put 225 in this, and we've been paid out already 779,699. So again, this is one way that we can kind of stave off inflation. Hopefully it doesn't hurt our pocketbook as much as if we were to use, something that's static, and just another arrow for your quiver. And then I don't have a screen for it, but I'm going to toss this now back over to
Hey, Chris.
Yeah.
Before you hop off, I got a couple questions that I wanted to put towards why we're then going to use that 75,000 into the National Western Life Select Returns at age 82, 83, right there. If this person passes away, what happens? Is it just done? Is there no death benefit at that point? Am I reading that correctly?
Right. Yep. You're right. So on this one, at that age, your death benefit is 0.
Right. So, hey guys, here's the great thing, and this is what it is, and this is what we wanted to pull together. Not Chris's fault, my fault. I did not get the spreadsheet over to him, but I will share it with you up on my screen. The annuity is going to give you that increasing lifetime income forever. It's a fabulous product that's there. But we're able to give that income and we don't need to use 300,000, right? We're able to use the 225,000. It's going to fit this particular person's need, and that income goes up. But now what happens, this person, their life expectancy or whatever, I'm sure they're hoping to live past age 80. Well, what we're able to do is we're able to make sure that we don't disinherit everybody. And we're able to make sure that if this particular person's spouse is still alive, or if it's, children, we're going to be able to have the ability to show them something else. Now, I'm sorry here, this will stop other screen sharing. Do you want to continue? Yes. So as the other annuities paying out, given the income, the National Western product, what that's able to do for us, if we look right here on this 60-year-old female, right? We are able to have a $75,000 deposit go in that on day one is increased to $157,000. All right. Now, let's follow life and talk about this here. That's great that increased that there. Something happens to her at age 65, right? There's 200,000 at this point now that's able to pay out, that's able to offset any taxes that are left on the annuity over there, to help more money pass along. Also, you have a full return of premium from day one. No matter what, you could get back 75,000 or some portion of that. So if anything were to happen in any given year when we have the annuity in a payout position, right, when we have it given an income, we do have the ability to go in here and supplement that income if needed with up to 10% penalty-free per year. Or you can fully surrender if you wanted to and get all your money back. But really the best option that's here is the fact that it gives you the death benefit to offset taxes. It gives you the bucket of money that you could go in and supplement if something were to come up that you needed it. But lastly, if none of that ever happens, right, we do have the fact that this is going to grow with a guaranteed minimum of 2, and right now it has an upside of 9%, and we will see our account be able to grow as long as our death benefit grows also. Here's the deal. When we go down to age 82 or 83, what you're going to see here is when that annuity is still paying out, but let's say the person passes away, there's nothing left of that asset. But what we did right here, again, we're able to double that asset. We're able to recoup that asset. We're able to pass it on to the next generation. You can see we got a death benefit at this point that has grown up to the range of 250,000. Okay. That's a pretty good deal. By thinking outside the box, we're able to give our client the income that they need. That's going to be tax favored income, right? It's going to be able to grow to help offset inflation. This gives us more liquidity because we do have the $75,000 that is able to be gotten to. And on top of that, it gives us the death benefit that's going to recoup those annuity dollars to the beneficiaries on a tax-free basis. So again, with my theme, what it is and what me and Chris do when we work with advisors is we really like for you all to come to the table, talk to Bernard, and try to bring as much of that picture to him as you can. Then when you bring that picture to us, we are able to help put together an idea. Now, I want to let you know it doesn't always work. Sometimes it all has to go into the annuity because they need all the income right now, and that's that. Okay? But when the life insurance does work, it's beneficial not only to the client, but it's beneficial to you as well, because Chris, I thought it sounded really good when he said it there. He said that additional sale, right? Because we're talking about an annuity and this single pay product, which by the way is a simplified issue plan that you will have issued, or you'll have it approved and know that it's good to go within an hour. Okay. Very simple, very easy. This is, you know what? I about completely forgot that. With that being the case, if this person were to be declined within that hour, very easy for you to pivot back, and we just say, all right, we're going to boost your income on the annuity, and this gets popped right into the annuity. Okay. But, the whole play works together. Get it over to us and let us show you what all the possibilities are. And when it works, we'll bring to the table the plan that includes life insurance, and we'll put it together and make it as easy as possible for you to complete that.
So,
So
hey,
that-
guys, I'm sorry. We have a question, and I think you may have answered it. But Noah asked, well, what about health conditions and the ability to stay in the game? Older clients, 70 or older years, may not be in the best of health. So I do believe you answered that question.
Yeah, and yesterday I said this, and I'm going to say it again. People get scared of not being in good health. Who really is in good health? I mean, seriously, I see people, I'm just going to say this, everyone. It's like 97.2% of all life insurance applications get offered life insurance. Like I said yesterday, it doesn't mean it's standard. They might be rated, right? But I want to let you know something. I've had a person that had breast cancer that's gotten preferred, and I've had another person that had breast cancer that's gotten denied. So don't be scared of what the health conditions are. Just get an understanding of what they are, write them down, ask some rebuttal questions. You got diabetes? How long have you had it? Do you take insulin? When did you start, doing that? Ask some of that stuff, get it back to Bernard. He'll get it to us, and we'll take care of that for you. We will not put you in a bad situation. Remember, the idea here is you're going to bring all the information back to us. We are then going to put it together. And if the person is too sick or their health conditions are too much that they can't get life insurance, you'll know that, and it'll just simply be the annuity that gets passed on in the plan package for you. Okay.
And if I may interject, when we look at this policy that you have up right here, Chris, this National Western policy, it's simplified issue. So I know the tendency in because a lot of my annuity producers they don't write so much life insurance, but they all cut their teeth in life insurance. And I think why they get away from it is the process, right? Getting labs, making their client go to the doctor to get a physical, getting blood drawn, all that stuff. It's a process. It takes longer to get paid. Now, I'd submit to you that, on an IUL policy, you're probably going to get paid more, but it's going to be a longer process, right, to get paid. This policy here, simplified issue. You don't have to waste all your time with sending your client to get poked and prodded and whatever other obstacle that you're going to make an excuse for. It's on the paperwork. I don't know how many questions. Chris can probably tell you about that, but you can just walk through all the questions, and as soon as they answer no, hey, deal's done. This isn't an option for you. We'll move on, or we'll put that asset, the rest of that asset, into the annuity. But this is a real easy way. And as you can see, the total asset that you get that we did in the scenario is 300,000. And if they live to their mid 80s, they basically recouped what they put in back to their beneficiaries. I mean, and this is as simple as it gets. So for those that may not have taken a liking to the life insurance, this is an easy access point. There isn't really no barrier to entry to present a life insurance policy when you're looking at this National Western.
So true. Thanks, Chris. I mean, that is it. And we will get through, Bernard will get to you pre-screen questions, and you can see what it is. It's very, very, very easy. And just, let's not put roadblocks in the way. Let's think of possibilities, right? And you ask them the 12 questions. If they answer them yes, you do a phone interview where they're going to ask the same exact questions, but they're going to go through a motor vehicle check and a prescription check. They will get that done. Okay. If they get declined, like Chris said, you just say, okay, we're just going to stick it all in the annuity. And that's that. No harm, no foul.
Mm-hmm.
All right. That's what I got. So I hope that helps out. And I do look forward to helping many of you with some of these simple ideas, but to completely pull it full circle, this is what Bernard and Chris and myself do, is we put our brains together, work together to put a case design that puts you in a good light in front of your client and gives you the best opportunity to put them in the best situation for success, while making sure that you attain success as well. So thanks.
Okay. All right, guys. I think we have a question here. Well, thank you, Noel. Yeah, and I was telling you guys yesterday that I totally believe in the holistic approach. I mean, you need to have both worlds. You need to have the life insurance and you need to have the annuities. And like you said, if the life insurance doesn't work out, you have the annuity to fall back on. So no, Chris and Chris, I thank you guys. And then to add, you say gravy to this, we have Nick Mancuso on here. He is with Retirable, a financial advisory firm, and he's going to talk about how to marry with life insurance, annuities, and equity products. So here, go ahead, take it away, Nick.
All right, Bernard, thank you so much for the introduction. Excited to be on with y'all, tell you about how I think we could provide a great experience for your clients and some additional revenue for you. I'm going to share my screen here. So we are Retirable. We are a financial advisory firm based out of New York City, and in all 50 states. We're digital advisors. So a little bit about myself. My name is Nicholas Mancuso. I'm the director of sales here at Retirable. Got my start in insurance and annuities myself, but moved over to the fiduciary financial planner and investment side later in my career. But I really want to tell you more about how we can supplement your income here. So,
hey, Chris, let me stop. Nick, let me stop you right quick. If you put your stop your video, because we're getting a little static, and let's see just the video part. You can still share your screen, but the video part. See if that'll. Yeah.
Is that a little better? Is it working?
We'll work through it.
All right.
Work through it.
My apologies. Can you hear me though? Okay.
Yeah, it's loud and clear on my end. I'm not getting any static. I don't know
Okay.
if that helps or not, but
okay.
All right.
Okay.
But yeah, so Retirable's partnering with IAD to supplement your income. And what we could do is we could provide up to $750 per client that you introduce us to you as your fiduciary advisory team. We don't, for context, we don't sell any insurance-based products. We don't sell any insurance or annuities or Medicare, so we're not competing with your business on that front. But what we can do is help to supplement your income by providing holistic balance planning for your clients. So a little bit more about us. Our design here is to provide a team across health and wealth, and to supplement the insurance and the annuities that you're selling in addition to the healthcare that you're selling to your clients. So if you've ever had clients ask you about things like, when do I elect Social Security and what is the optimal time? What do I do with spousal benefits and things like that? What is safe to spend so I don't outlive my savings? What is the actual amount that I need from these annuities? And how should I invest my retirement savings to supplement these things? We are the perfect fit to help answer that question. We are working in the exact same demographic. 60 and older is really where we focus on creating distribution for your clients. So I'm going to tell you a little bit more about financial balance. I'm going to do a little demo for you and tell you how this incentive actually works. So a little bit more about Retirable. We are helmed by an experienced team of fintech operators based out of New York City, and we're also an investment-backed company. So Mark Cassidy, the former CEO of LPL Financial, is one of our investors, and the reason why they invest in us is we're trying to solve this major problem in America today. And that problem is that 72% of Americans enter retirement without a comprehensive plan. Right? They're missing out on crucial Social Security optimization planning, pension election planning, investment income, and spending advice throughout their retirement. So it's not just setting them up at the beginning and setting them going. This is a constant kind of adjustment as their plans change throughout retirement. Maybe they're moving homes, maybe unforeseen circumstances come up. What do we do with our withdrawals, and how do we actually pivot and take these things to make sure that our plans stay true and we're still accomplishing things? But the primary fear that we get is that clients are afraid of running out of savings. And you could see that when you're selling these annuities, they really want that fixed income. And the reason why 72% of Americans don't have a plan is because it's very cost prohibitive for them. Most financial advisors that deal on the equity side really only focus on individuals with $500 to $1 million in assets and above. So a large portion of America, almost mass America, is considerably underserved here. So Retirable's goal is to provide professional retirement planning for every American out there. And what we do is we provide dedicated advisors to every single person that we speak to. It's a one-on-one relationship We know their story, we know their goals, we know what's going on in their lives. And we're able to build this holistic plan, which includes the insurances and the annuities that you're selling inside of their plan to see what their income is going to be in retirement and what is safe to spend. But really what we want to accomplish is give them this feeling of financial confidence that everything is now working together. And we do all this with industry low fees around 0.75 based off of what we're managing. But most importantly, we are fiduciary advisors, no commissioned, salaried agents who are legally obligated to do what's in your client's best interest, so that you can trust that when you send somebody over to us, we are going to do the right thing for them. We also have no account minimums on the investments that we are managing. And clients love us for a couple of reasons. Most in particular is we make things simple. A lot of financial planning is very complex. As you saw before, that there's all these companies that are trying to put information on Google and educate and things like that, and it creates this kind of noise barrier and that complexity that comes along with this planning. How do we simplify that out, take the structures of what we're selling and the products that we're selling, make them all fit together and make it understandable for that client? That education piece is paramount. You could see us mentioned on Forbes, you could read us on Trustpilot online, but in addition to that simplification is, the reason why clients really love us is this is the first time that they're seeing everything together on paper. They could see their Social Security elections when we do that, how that impacts our plan. They could see the annuities working for them, the insurance working for them, the long-term care working for them. How does this all fit together? And how do the supplemental investments that we make, how does that provide flexibility for us? And clients love us so much that when we do a free consultation for your clients, and that is a benefit that you get for working with IAD, that all of your clients are eligible for a free consultation with us, we will build them a complimentary plan. 1 and 2 decide to become investing clients with us. Now, I want to talk a little bit about financial balance, and this is more an abstracting of what we see from our clients on a day-to-day. But most clients come to us with this large kind of anxiety as they transition to retirement, whether it's pre or post. And that anxiety is really about, I know what pieces are out there, I know what products that I have, but how do they all work together? How do they fit together if something happens that wasn't expected and all of a sudden inflation goes nuts and I crash my car and I have to buy a new one and it was 17 years old and the blue book value is only $4,000? Where do I pull from? What do I do? What is a strategy I want to take? So we see 2 major contradictory thoughts coming through from seniors. They want stability, they want low risk, and they want to know where their next check is coming from. But at the same time, they want control, they want flexibility, and they don't want to necessarily give up all their assets. So how does this all fit together? Essentially, we need to build a holistic and workable plan. And what that means is we don't want to put all of our eggs in one basket. An annuity is a great source to create fixed income on top of Social Security and a pension. A life insurance is a great way to mitigate taxes and pull that additional income, but we still need this small piece of flexibility to be out there in case we have uncertain events or our plans materially change. Both are majorly impactful, and that's what allows this plan to be workable as our clients change in life. So we know that our fixed income side is subject to inflation risk. It's subject to interest rate risk, and it's also subject to rising costs in like unforeseen circumstances, like a car accident or a health issue, right? Now, on the variable side, we have market volatility, which we can fix with a lot of these fixed products, these annuities and these life insurances that we're selling, but we still need that variability out there. So how do we monetize that aspect that we're leaving over for our clients to give them this satisfaction and this workable plan while still making sure that everything is in the right place? And that's where we come in. I'd love to show you a little demo about what we're doing and how we do this for your clients as a free consultation. So this is Jim and Pam Halpert. If you know them from the office, except I've aged them up a little bit to be kind of in your core client base. Jim and Pam are both 66. Pam is 67. They are just retired. They may be on their 2nd year of Medicare, which you guys are great at selling for them. But they're a little confused about when to take things. They're not sure of when to take Social Security. They're not sure about what is safe to spend and what kind of budget they should live within, or actually how to manage their liquid assets according to that. When we look at Jim and Pam, we could see a typical profile. They may have a little bit of money in Roth. Jim has a current 401k that he's going to stop contributing to before, a small taxable brokerage, and Pam has a 403b left over from when she was a teacher, right? If they're like most Americans as well, they have a big primary home, which is the majority of their assets. And if they're like most Americans, they also recently refinanced in 2019 or 2020 when the interest rates are very low. All right. Now, they still have a little bit of debt. How do we pay this down? How do we mitigate and create that cash flow is a real problem for them. When we look at their cash flows, we can estimate what Jim's Social Security is based on his income if he doesn't know it offhand. But for Pam, we know exactly what that amount is. And we have this annuity that we've sold them already. So we know that annuity is going to give them $18,000 and change per year to supplement their Social Security to get them along that line. Jim just left a well-paying job. Pam just left as well. She was working part-time a little bit in the ending years. But what we see here are these major expenses that we need to protect. Their housing must be covered. You have to live somewhere. This is a core expense that must be covered. Debt as well can snowball. If we don't take care of our debt, that interest rate's going to hit us over the head, and it's going to make things out of reach. And that snowball can actually occur when we fix too much income because we're never able to draw enough to fight that interest. We want to build goals for them in terms of their expenses, but that's mostly lifestyle. But the big one here is their healthcare costs. So when you're selling to them and you're telling them, here's your premium, here is the out-of-pocket max, and they're saying, hey, that seems a little bit expensive, but I really want silver sneakers. We can make that premium and fit inside of their plan and help support what you're selling on the annuity and the life insurance side as well. Anything left over goes towards living expenses. So they'll tell you, hey, I think I spend this much extra. I want to travel. Here's what I want to spend. Great. We build that all into a comprehensive plan for them, and we can actually play around with variables in here to see what the optimal strategy is. So if they need to spend $4,750 a month, we could see a shortage come in here around 80 years old, even though we have that annuity in here, because these goals and the unforeseen circumstances that they have at play might push them out of that realm of the fixed income that we have planned. What we can do is start to plan with them around timing as well. So maybe Jim needs to work a year longer to cover that. Maybe we can push out Social Security and build a larger bridge where if Pam works a year longer and Pam pushes out that bridge, we now have more flexibility inside of here. So adjusting timing becomes very important. In addition to that, we can adjust where they're saving if they're pre-retirement. So if they're putting money into a Roth or a 401k, if they're contributing during their working years, we can actually see the difference that this makes inside of their plan and give them a savings plan to accomplish their goals, which we can later fund that annuity with. In addition to this, we want to make sure that we're covering all their goals, including net worth, in case we want to leave a legacy behind. So life insurance may leave a legacy, but what do we do with our liquid assets if we're trying to make sure we don't dip down below the level of liquidity and start having to go into our housing and our fixed or our non-liquid assets to kind of pay off and fund the retirement the longer we go with that longevity risk. All in all, what this gives us is a very good idea of what distributions look like and what strategy we can actually implement to mitigate taxes as far as possible, including withdrawing from a TERI plan or a tax-exempt retirement income in life insurance and the annuity that's giving us fixed income, possibly from a qualified vehicle. Sequential withdrawals means that we're going to pull from taxable first, then tax deferred, then tax-free. It'll result in lower taxes and a higher ending net worth for these clients. And what we do is we take all this together and we say, hey, what does this actually mean for the distributions that I'm going to take? How does my cash flow actually work? And we could see the time horizon that we have to pull and the amount that we need to pull on a yearly basis, given the conservative growth rate inside a normal investment. From there, I now have a great idea of what I'm pulling. And based on that time horizon, we're able to build an investment for your clients to supplement their annuity, to supplement their life insurance proceeds, and to say, hey, how do we build in this flexibility into this plan and create that income structure with the flexibility so everything is now comprehensive and workable? As we do this, we're able to see three major buckets, and I'll show you a second this loads. But essentially, we have three core buckets. It's the funds that we need to pull in the next year, and we keep those in cash. We want to make sure that liquidity stays where it is. So we know that any subsequent year, here's the distributions that I need to take. I'm pulling market volatility away from that. In the next 10 years, I want to invest stable. This might be bonds, other fixed income instruments that we can pull on that are a little bit more reliable, but still subject to interest rate risk. And anything with a 10-year or longer horizon is invested for growth to compete with inflation and to give us a flexibility bucket that we can pull on later. Now, I have this set a little bit high on the expense side to show you how we can adjust and make things happen inside of there. But this is everything that your clients get for working with you. And we can be that fulfillment center to give them that peace of mind. So as we think through working with your clients, not only can we increase and potentially double your revenue on a year by giving you $250 per person that we speak to that is qualified, we also give you $500 for every person who becomes an investing client with Retirable, up to $750 per person that you send our way. But not only that, we're constantly dedicated advisors who are touching your clients every quarter and once a year doing an overhaul. So we're going to increase your client satisfaction, preventing any other advisors who might be trying to step on the insurance sales you're making and the Medicare sales you're making by giving them a holistic view of everything that they need. But because we follow up quarterly, every Q3, we're going to reach out to them and say, let me know what your new Medicare premium is. Please make sure you speak to Blanket IAD to make sure that we have that and update your plan in Q4 once we have that locked in. We're also able to reinforce your sales efforts with planning. So selling annuities is difficult. Selling insurance is hard. Tell us what you're working on with your client. We will build that into the plan and show them how workable this actually is to make everything work together. So not only will you receive additional revenue, but you're going to strengthen your client relationships by doing this. And we want to make it easy for you. We know that you guys are busy during annual enrollment. We're busy selling insurance products and annuities. We're busy selling Medicare. We don't want to put more on your plate here. So what we're going to do is make it as easy as possible for you. IAD has a dedicated email and phone number here with Retirable that when somebody calls in, it already attaches to you guys so we can track all the things. All you need to do is have a conversation with your client. Let us know your full name, their client's full name, their email address and phone number, and we will handle all the rest. If you want to be on with your client as well while we do this, you're more than welcome to join us on a Zoom. All right. So the idea is to make this fast, easy, and lucrative for you as much as possible. So if you're ready to get started earning and you're looking to get up to $750 per additional client, please let us know. We will provide content for you in terms of marketing, email templates that you could send to your client, but we can take advantage of the variable aspect that we're not including in these annuities and insurance and monetize for that for you as well by providing additional revenue for your practice. I'm going to send Bernard over all the information so he can share that with you guys, but I wanted to open it up for any additional questions that you might have for me.
Any questions, guys? I mean, this is actually a great opportunity to sell your life insurance, your annuities, as well as recommend your clients to Nick for the equity side of it. So great opportunity, and get a little bonus too. All right, Chris, Nick, my apologies, I'm dealing with the Chris's all day long today. So no, I don't see any questions, Nick. Let's see, we got.
All right. Well, I'm looking forward to working with everybody. Bernard, I'll send you all the information so that you can share it out, but really appreciate it. Looking forward to creating more satisfaction for your clients, increasing your revenue, and helping you close these deals.
Nick, I really appreciate it. And tell the guys at Retirable, thank you. And see if we can make this work for everyone. Before we let folks go, as I said earlier on in our presentation, we have 2 giveaways, 2 $50 gift cards to give away here. I'm going to mute my video so I can look at the attendees and put the names in a hat that we have and pick 2 of our agents. Here, just give me a couple of minutes, folks. All right, folks, I'm saying back now, and from a little drawing that we had, Congratulations to Carol Burke and Jeremy Nicholson. Both will be receiving $50 gift cards from us, as well as each person that was joined in with us today. You will receive a free website design consultation, as well as a social media marketing consultation. So we'll get all of that information to you, and have a graphics team reach out to you guys to set up appointments. So folks, I really appreciate you. This last couple of days on our day one was our Life Annuity Academy. Today was our Annuity Academy. I'll be reaching out to every one of you, talking about next steps, contracting. If you have any case designs, if you need to reach out to both Chris's or even Nick. So we are here for you. Again, thank you guys for attending, and we will be in touch soon. Thank you. Bye.